ChartIQ users to this educational series from GoNoGo Charts. My name is Tyler Wood, and I am a CMT charter holder. And with me today, as always, is Alex Cole, the chief of charts and creator of all of these GoNoGo tools. How are you today, my friend?
I'm doing very well. Excited to get through some of this educational material.
Absolutely. Now, today's session is the first in a multi-part series. We're going to talk about trend identification. And here at GoNoGo Charts, one of the most important things that we drill home for ourselves and for all of our clients is the need for a repeatable, structured process, a set of rules or checklist, if you will. We know that trading can feel very different in different market regimes. You might have noticed that you felt differently in 2022 than you did the year prior, or than you have here in 2023. And certainly the outcomes of individual security trades might look a little different, but your rules have to remain constant. You need a repeatable, robust approach that's going to use the weight of the evidence, a multiple tool method, a checklist to help you stay on the right side of trends. And to help illustrate that point, Alex, why don't we talk about what's going on with your teenage son right now?
Yeah, I mean, it's the end of the school year. We've got one graduating middle school and my son moving into his junior year in high school, which seems absolutely preposterous. I'm not that old. But yeah, like you said, he's learning to drive. And as any parent, you want them to be as safe as possible when behind the wheel. And if you think about it, what you want to do is have him do certain things every single time he gets in the car to make it as safe as possible. You want him to put his seatbelt on. You want him to keep his foot on the brake so he doesn't jump forward. You want him to check his mirrors. You want him to signal so that cars behind him know what he's doing. And then finally, you'd want him to put it in gear and drive off. And if he does all of those things every time, he shouldn't pull into the path of oncoming traffic with not enough time to get going. And the same can be said with technical analysis. We want to remove the risk. We want to be as safe as possible when making decisions when looking at securities. And that can be done with a disciplined checklist of technical analysis. And it could be any number of things. You could use Dow theory, you could use trend lines, moving averages, different pattern analysis, or you could use indicators to do that, as we'll see. But if you have this weight of the evidence approach, you're going to give yourself the best chance of making a sensible decision and doing it in a way that avoids some of the pitfalls of investment analysis.
So let's walk through what a responsible approach to trend identification might look like using traditional technical tools, Alex.
Yeah, so the first one that we might look at is just using our eyes, using the visual understanding of what's happening on a chart. And if we can see some sort of discernible direction from, let's say, lower left to top right, then we know that's a trend, because what we're identifying is a series of higher highs and higher lows. And that's the definition of a trend, an uptrend. And if we can do that, then of course we've sort of mastered the most important skill in our discipline, and that's to identify trends in price action. If we can do that, we can profit on the majority of the move. We like to say that it's simple, but not easy. So we might need some help in doing that. And of course, then we may try to automate that process to take away some of the subjectivity of using just our eyes. And of course, using the visual approach is very easy looking back, right? Like if we're on the right side of this chart now, we can look back and say, yes, we've had a series of higher highs and higher lows, and we're in a trend. But this trend has been in place long enough for us to realize it with our eyes. And so that sometimes diminishes the efficacy of just using our eyes to identify trends.
Absolutely. Tools in hindsight. The Monday morning quarterback doesn't really help. So we might look to a tool like Donchian channels or price channels to help us remain more objective in identifying those series of higher highs and higher lows. Donchian channels, if you're familiar with the turtle traders, our dear friend Jerry Parker came out to the CMT symposium this spring, and we got to spend some time talking about trend following investing. Donchian channels is one of the primary inputs to trade entries taught by Richard Dennis to those turtle traders. Highly recommend that you pick up that book if you're interested in a really compelling story. But the basic premise of Donchian channels is that it's simply going to plot a line above and below our price action, representing that current high or low over a look back period. Now we're going to track those new highs and lows over that set period, which is going to help us remain objective about whether or not there is a trend. It's also going to help us smooth that daily price action, or that smaller intraday time frame, if that's what you're looking at. We want to separate the signal from the noise, and Donchian channels is just one of those tools that we can use. Alex, let's talk about maybe the most tried and true simple moving average.
Yeah, when we worked in the industry, we often joked that simple moving averages aren't even going to count as core technical analysis because they're everywhere. People that wouldn't even consider themselves technicians have moving averages on their charts. And if you think about it, that makes a ton of sense, because looking at where price is in relation to a historical average of those prices gives you a sense of whether or not there is something happening in terms of trend. Think about it. If a price is trading above an average of its prices, then that's inherently bullish. We're saying that price right now is higher than it has been in the past. And that's a way for you to identify price moving higher, just like identifying that new high with Donchian channels. So if you're using Donchian channels, you're identifying a new high, you then see price crossing above a moving average, that starts to tell you that something might be happening.
Absolutely. Paul Tudor Jones is famously quoted as saying, his metric for everything I look at is the 200-day moving average of closing prices. This is how prevalent and important these tools are. Now, if one moving average is helpful or powerful information, why not throw a bunch on there, right? We could use 3 moving averages and look for different crosses between say a 20 period, a 50 period, and a 200 period. That would give us even more insight. Are those moving averages rising? Are the shorter period moving averages above the longer period, helping us to identify trends, but of course, adding more to our chart. Yeah. So Alex, let's talk about how we could use these crosses to find entry points and exit points. But again, there's some interpretation, some subjectivity for which of the multiple moving averages you're using counts as your buy or sell signal. And you have to set those rules based on the parameters that you're using. Let's talk about another one. Yeah. From John Bollinger.
Yeah, Bollinger Bands so prevalent in the industry. And what we like to look at with Bollinger Bands is when there is something significant happening. If you think back to your math classes, in the dark ages, we've been out of college for a while now, but the statistical analysis of standard deviations tells us that within a normally distributed data set, when you have 2 standard deviations around the mean, you have about 95% of the data should be contained within those 2 standard deviations. Now, we know that financial data is not normally distributed, but if we take that idea and say, listen, if price is outside of these bands, that's pretty important information for us because it doesn't happen very often. And we also know that there's a couple of different ways to interpret the bands. So what we look for with trend identification is when the bands are narrow, and then we see price break out of the band, we typically would be told by Bollinger's work over the past several decades to trade in the direction of that break, because we've had a narrowing of the bands and then we've had a price movement outside of those bands. That's significant. So we would look at that as perhaps the start of a new trend. So Bollinger Bands can be very helpful as well in this regard.
Now, beyond what we're looking at on just our price panel, we can start to introduce additional confirmatory indicators, something like volume, which Charles H. Dow told us over 130 years ago, the importance of seeing market participation supporting that price move, seeing from a confirmatory indicator that indeed higher prices are backed up by strong volume and market participation. Now we start to add a histogram to the chart that also gives us important information, but shrinks our price panel just a little bit. So we can see if price action is supported or coming to a point of exhaustion. And Alex, let's talk about one more derivative indicator from price and volume studies, the MACD.
Yeah. I mean, when you start looking at these charts, you're going to want to have some other indicators on there to provide that confirmation or that lack of confirmation from what you're seeing in price in the upper panel. And what a lot of people look at with MACD is, where is that MACD in relation to its signal line? We can go into the calculations of MACD, but the traditional usage is using the crosses of the MACD and its signal line. We also like to look at where MACD is. If MACD is above 0, that's bullish, right? Because that's telling us that the shorter term moving averages are higher than the longer term moving averages. So that's, again, looking at how fast price is moving in the more recent short term compared to the longer term average of its prices. So you can now start to see that if we go through this list, we've got new high and Donchian channels somewhere in this oval that you've added to the chart here. We've got price crossing above its moving averages. Of course, it crossed above different averages at different stages, but you've got perhaps as well the price breaking to the upper band of that moving average, of that Bollinger Band, while the Bollinger Bands were relatively narrow. We talked about how that could be used to identify the beginnings of a trend. You've got volume to look at as well. Is there enough volume? Is there enough participation to back up what we're seeing in price? And then in the lower panel, we're seeing how MACD and its signal line are moving above 0. And so at some point in this blue oval, as an analyst, we'd be relatively comfortable saying that we are seeing the beginnings of enough structural evidence to tell us that price may be moving in an upward direction.
Now, this is a very simple process, right? We have just a few tools in our checklist, confirmation from multiple different inputs, but we all have seen charts like this. Heck, I think I've even created charts like this in my early days, because the more you study about technical analysis, the more important that next piece of information is. And these incredible indicators developed by the men and women of Wall Street and Dalal Street and Bay Street and all over the world that help us with our analysis, understanding investor behavior, understanding price action. Now, when you think about coming down to a trade decision, all of that subjectivity that we're trying to remove, controlling our emotional bias, remaining objective, looking at the weight of the evidence. Once you throw enough squiggly lines on the chart, you can either introduce analysis paralysis, right? Meaning you're spending way too much time interpreting the information being presented on your chart, or worst case, you could convince yourself of whatever you want to believe, right? That trade is working against you. You're down 20%, but there's enough something in your chart that can convince you to hold on because it's going to turn around. Your conviction in that security is so strong. Well, that's what we want to avoid. We want to simplify our trade decision-making to better manage risk and to better capture rewards. Sticking with trends, as Jerry Parker will tell you, is one of the hardest things, right? That you don't sell out after that 20% move to the upside if it is indeed trending for a 200% move. Yeah. So Alex, let's talk a little bit about the solution to this problem of indicator overload and analysis paralysis.
For sure. And what we've done is tried to take a really strong list, a checklist of foundational concepts of technical analysis, some of the most statistically tested, robust tools that we have at our disposal to help us understand trend, and blend them together into something that color codes price according to the strength of that trend. And so that's the foundation of the basis of GoNoGo trend. And what you'll see is that as a security rolls through its trend, we will see colors changing to paint the strength of it. So, of course, the colors on here, there's 5 of them. We have 2 for weak form and strong form in Go trends, which are bullish environments. And those are the aqua and the blue color, the weak and strong form respectively. And in a counter trend or in a no-go move, a bearish move, we have pink and purple, the weak form and strong form respectively of a bearish move. And then if you see the odd amber bar there, those are our go fish bars. And those are bars that represent uncertainty. There are not enough of the inputs or the criteria being met either to tell us that we're in an up move or to tell us that we're in a down move. And of course, we've got go, no go, and go fish because we're both big fans of the work of Jesse Livermore, and he is famous for saying that there's a time to go long, a time to go short, and a time to just go fishing when you aren't being given the information that you need from the market to make a decision one way or the other.
Now, the other very important aspect of technical analysis is the classical study seeing important price levels of support and resistance, being able to identify that polarity principle where what has been resistance once broken through can act as a support area. We can do all of our classical pattern analysis, and we can indeed keep our focus on price action, which of course is our most important indicator of all, is the price of the security on any given day or period. So when we're looking at a GoNoGo chart, we want to keep our focus on the price action itself, but we don't want to lose all that valuable information from our checklist. So we compute all of that extra data in the back end, presenting it as a simple, elegant, color-coded chart that gives you direction and strength of a trend in either direction. Now, Alex and I are so proud of this work, and it's tools that we have developed sitting side by side with institutional portfolio managers, research analysts, and traders throughout our careers. We want to introduce that to the rest of the world. We want to improve the process and decision-making tools. We're so proud of that work that we're just giving it away for free. So right on your ChartIQ implementation, you can add the GoNoGo trend indicator directly to your chart from the study library. All we would ask is that you let us know how it's working for you. What time periods are you trading? What securities are you trading? And has this improved your decision-making process? So from us at GoNoGo Charts, thank you so much for checking in on this video. Hopefully you'll come back and check out the next 5 installments of this multi-part educational series from GoNoGo Charts. Please shoot us an email with any questions, info@gonogocharts.com. Until next time, be well, stay safe, and we'll talk to you soon.